We should get to the stock of the day, which of course is CSL, downgrading its 2026 FY earnings and warning that it expects to book around $5 billion US in additional non-cash pre-tax impairments. So reporting total revenue of $15.6 billion in FY25 and a profit of $3.3 billion. But its interim CEO, Gordon Naylor, is saying that growth initiatives were working, but the financial benefits will take longer than previously anticipated to materialize. As a result, downgrading that 2026 financial year guidance. So it's expecting revenue to come in at $15.2 billion and net profit of $3.1 billion US on a constant currency basis, citing weaker than expected contributions from US immunoglobulin sales, albumin pricing pressure in China, and softer growth from its iron business. So the shares have been absolutely decimated, diving to an 11-year low today. So the question for my guests is deep value or a value trap, or Sanjee, is it just getting to where you guys would like to pay more for CSL?
I think CSL's actually overcorrected in a lot of aspects. I mean, we were looking at it more recently at around a 13 times PE. Now it's probably close to around 11 times, and possibly it could go down further. But looking at what Gordon Naylor set out this morning, and a forecast for FY26 earnings being about 3.1 billion. Let's put it into context and cut through some of this noise, because FY25 was a record year for CSL. The net profit for CSL for last year was 3.136 billion, which is pretty much on par of where they're going now. So yes, they've been hit, their growth hasn't been there. They have written down a lot of the assets that they had in the business, but you'd have to have seen that coming when McNamee and Naylor decided there's going to be a change at the management level. Naylor's going to come in, start changing things around and course correcting the ship. So there are challenges CSL is going to go through, but in terms of a business and what it's producing, how it's able to earn money and where it is for the long term, I think if you cut through the noise, you'd actually see a much clearer picture of a really stable business with some strong moats around it that haven't had any moats breached and haven't had any significant risk triggered. So it'd be something that is quite attractive at the moment. I'd be looking to add a bit more to my portfolio at this stage.
Yeah, just to push you on that point, because I know stability matters to you guys a lot. So what we've seen lately, isn't an indication that that stable story is breaking down?
No, it doesn't look like it. I mean, at this stage, CSL's had a good run, and it doesn't mean every year it's going to be growing significantly outperforms. Yes, it will affect the stability of CSL, and in terms of its earnings, it will get impacted. But CSL has been a very stable business that a slight impact in a couple of years is not enough to penalise a company in its entirety. If it's constantly swinging quite drastically up and down, or if it's a cyclical business, then I'd be more worried. But in this case, the net profit from last year and net profit from this year are pretty much on par. So I'm not considerably worried about that.
Okay, so it's a buy for Sanjee. Now I wonder, David, the other, way to look at this is that the wheels are kind of coming off CSL right now. Or is it just great value?
Well, I think it's probably a bit of a combination of both, Nadine, that we are definitely seeing the wheels falling off as far as the share price is concerned. I mean, this is effectively the fourth downgrade that we've seen this year. And as you can see by that chart, it's been a significant leg down each time. And we haven't really seen much of a bounce after the initial fall. So perhaps this time we might start to see a bit of a bounce. Hit $95 or thereabouts this morning. It's slightly off that low at the moment. But there will be a time, and it could well be very soon, that we will start to see value buyers come in and look at CSL. As Sanjee said, they're trading on a PE ratio of around 11 or even 10 times at the moment. And they are profitable. They do have a good balance sheet. They do have good products. There is long-term demand for their products, and they are a global business. So they do have a lot of positives for them. The issue with CSL is that historically it's been seen as a growth company, and people have been prepared to pay 20 or 30 times earnings for it. It's now 10 times earnings. So you've got a different sort of investor who will be looking at CSL. But those who are prepared to, I suppose, have the gumption to ride out the potential volatility over the next 12 or 18 months could well be very rewarded over the longer term. We've seen it trading above $300. I'm not suggesting it'll get there in the short term, but definitely at current prices, they are looking interesting. We've actually got a hold recommendation on them, and our analyst had been a little bit concerned about the future, had downgraded the earnings at the last result. So you're perhaps not surprised by today's downgrade, but potentially we've been surprised by the amount that the share price has fallen down. So I think it is a point where we will start to look at CSL as being a buy again, and looking at that longer term outlook for it. But I think over the next couple of days we'll see analysts do more downgrades, and potentially we'll see a few more negative days before it starts to bounce. So at this point in time, I'd probably just put it on a hold, but definitely it's well and truly on the watch list.
Well, got it. Thank you, guys. So that's CSL stock of the day, a hold for David Lane, a buy for Sanjee Narendran.